In Britain, the public support for leaving the European Union is growing, but many politicians, including Prime Minister David Cameron, are opposed to the idea. This week, British lawmakers rejected a call to hold a referendum on the country's continued membership in the EU, with only 111 members voting in support. To talk to me about the economic impact of such a move is George Buckley, Chief UK Economist at Deutsche in London. Welcome to the show, George. So to start, what exactly would a withdrawal from the European Union really mean for the UK?
Well, I think the UK would find it very difficult. The problem is we export quite a lot to the European Union. Around about 50% of all our exports go to the EU, which is a very sizable proportion. And we have a lot of legislation which is tied into Europe. If we leave, I think that that would make it more difficult to trade. It would make it more difficult to move between borders. And that's, I think, good reasons why we shouldn't leave the EU.
Well, a referendum is held off for now, but do you think it's just a matter of time before one eventually takes place?
I don't think so, because when you look at that referendum, all of the parties, the major political parties in the UK, were against having a referendum. Their leaderships, at least. In addition to that, the vote was well and truly defeated in the House of Commons. There was 483 votes to 111. I don't think that's going to change anytime soon. And when you have all the leadership of the three political parties voting or suggesting that or whipping their MPs into voting against this, then I just don't think that's something which is going to be resurrected anytime soon.
So hypothetically speaking, if we were to have a referendum soon, how do you think the British public would vote?
I think the British public would be slightly different. I'm not sure they would vote for leaving the EU. We've already had that vote back in the 70s, and they didn't vote for it then. I don't think they'd vote for it now, but it's a very different question, I guess, to one whether we were asked if we wanted to join EMU, the single currency, which I think would have been a bad idea had we done it because of the impact it would have had on our housing market in terms of lower interest rates. But asking about the EU is a very different question, and I think most people would probably vote in favour of staying in.
Well, let's move on to the purpose of the European Union now. The UK has been part of the EU for almost 4 decades. But do you think that the deals coming out of Europe, particularly in the last few days, are in line with the original aims of the EU or represent a fundamental change from what the European Union was really set up to do?
Well, obviously, this deal was actually hammered out with all EU 27 countries. It wasn't just the monetary union countries, although that's really the primary countries who are going to be affected. So it doesn't really affect us quite as much. It affects us more to the extent that we do so much trade with Europe that if anything happens, such as a recession, if the economy weakens very sharply because of a failure to achieve a deal, then that would have had a big knock-on effect on the UK. There's a very good correlation between economic growth in the UK and also economic growth in Europe. So we had a vested interest to try and help achieve this deal. And of course, the deal was achieved, and we have to hope now that does improve the situation and encourage growth to return.
What about UK banks, though? Because obviously they are and will be affected by these decisions just like everyone else.
That's right, they are, and I think that the UK banks are in a much better position because we obviously we were the first country to recapitalise banks back in 2008. That decision was followed by other countries, the US and Europe, and I think that's quite encouraging. But certainly a recapitalisation of banks on the continent. The big risk, I think, from a recapitalisation perspective, is that it leads to a reduction in assets. It causes deleveraging by banks, and of course one bank deleveraging is fine. If all banks delever at the same time, you've got a problem, and that could potentially cause a credit crunch in the new year for new credit to households and corporates, and it might actually cause weaker economic growth. But in the long term, it's certainly a good idea for banks to delever and to achieve a higher core Tier 1 ratio on their capital.
Thank you very much, George. There'll be more interviews next week with some of the biggest names in the financial industry, but for now, goodbye.